All right, today we're going to break down the latest quarterly report from OxPay Financial. Now, look, I know financial reports can seem a little dry, but trust me, this one tells a really fascinating story. It's kind of like a business puzzle, hidden right there in the numbers. So we're going to piece it all together. Let's dive in.
And this is the central question, right? This is the whole puzzle we're trying to solve. It's a classic paradox in business. You see growth, which is great. It's exactly what you want. But at the same time, the company's financial health is actually getting worse. So how on earth does that happen? That's what we're here to figure out.
So let's start with the good news. For the first 9 months of 2025, OxPay's revenue shot up by 21% compared to last year. I mean, that's a really solid number. Any company would be thrilled to see that kind of growth. It suggests they've got momentum, that people are buying what they're selling. But as we all know, revenue is only part one of the story. And here's the plot twist. Over that exact same period of really impressive sales growth, the company posted a net loss of 2.1 million Singapore dollars. So on one hand, you've got a 21% jump in sales, and on the other, a multi-million-dollar loss. This is the fundamental conflict in OxPay's story right now, and to get it, we've got to dig a little deeper. Okay, so let's start by unpacking that top-line growth. In this first part, we're going to look at two really key things. First, where is all this new money actually coming from? And second, why isn't it turning into profit? This is where we start to connect the dots. This chart right here, it really visualizes that 21% growth we just talked about. You can see the revenue for the first 9 months, climbing from 2.8 million in 2024 up to 3.4 million in 2025. It's a clear upward trend. So the question isn't if they're growing sales, but how. And you know what? The how is everything. And this slide breaks it all down for us. OxPay has two main parts to its business. On the left, you've got their traditional merchant payment services, or MPS. You can think of this as their bread and butter payment processing. Revenue there actually went down a little bit. But look at the right side, the Digital Commerce Enabling Solutions, or DCES segment. This is where they help businesses get online. And its revenue more than doubled. So here's the kicker. Basically, all of the company's growth is coming from this one single segment. And here's the catch. The report is very clear about this. This high-growth DCS business, which is blowing up in Malaysia, is just less profitable. It's got a lower profit margin. Sometimes companies do this on purpose, right? They chase market share. But the effect is still the same. While OxPay is selling a lot more, each dollar from those new sales is bringing in less actual profit. It's a classic case of not all revenue being created equal. And you can see the direct result of that shift right here. This chart shows the company's overall gross profit margin fell from a super healthy 67% in 2024 all the way down to 54% this year. I mean, that is a huge drop. It means that for every single dollar of sales, they're left with 13 cents less to cover all their other expenses and hopefully make a profit. This slide is really the key to the whole puzzle. Okay, now that we understand the pressure on their margins, let's look at the other side of the coin, the expenses. In this section, we're going to see why that shrinking gross profit didn't just lead to smaller profits, it led to bigger losses. We're moving from the money coming in to the money going out. And we're back to this number, the SS 2.1 million net loss. But it's really important to add some context here. This isn't just a loss, it's a growing loss. It's actually 7% higher than the loss they reported for the same time last year. So even with all that revenue growth, the company is actually moving further away from being profitable, not closer. So where's all the money going? This table spells it out. Look at the cost of sales. It's up 69%, which makes sense. It's tied to that lower margin business we just talked about. Admin expenses stayed flat, which is great, shows good cost control. But then, whoa, look at the bottom two lines. Other operating expenses are up 46%, and finance costs have just exploded, up by over 260%. These are some serious red flags. Now, these increases aren't just random. The report tells us why. The higher cost of sales, that's from chasing that new business. The jump in other expenses was driven by a one-off fine. And that massive 262% spike in finance costs, well, that's almost all from interest on a new $2 million convertible loan. It's a way to raise cash, but it comes with a price tag, and that's the cost we're seeing right on the bottom line. So far, we've been looking at the flow of money, revenue in, expenses out. But now we need to check on the company's overall financial foundation, its balance sheet. This is what tells us just how much pressure these ongoing losses are putting on the business itself. Wow, this slide tells a really powerful story with just two numbers. At the end of last year, OxPay had positive total equity. In simple terms, what they owned was worth more than what they owed. But just 9 months later, that is completely flipped. The company is now in a negative equity position. That is a really significant downturn in its financial health. And that negative equity position leads directly to this. This is the kind of language you never, ever want to see in a financial report. The company itself is acknowledging that there's a material uncertainty about its ability to continue as a going concern. That's the formal, audited way of saying, hey, we are facing some serious challenges that threaten our ability to stay in business. So what does going concern actually mean? Well, it's a core idea in accounting. It's the basic assumption that a business is going to be around for the foreseeable future. So when auditors or the company raise a going concern issue, they're basically putting up a big yellow flag. They're saying, hold on, because of these net losses and negative equity we're seeing, that fundamental assumption might be at risk. It is a formal warning sign. But the story doesn't stop there. Management isn't just sitting back and watching. The report also lays out their plan to deal with this going concern issue. They believe they can keep the lights on by using their internal resources, getting financial backing from their main shareholder, securing another loan, and looking for other ways to raise money. This is their game plan to navigate through this very tough spot. And that brings us to our final section. What's next? We've diagnosed the problem, right? Growth in the wrong areas combined with rising costs. Now, let's look at management's actual strategy to write the company's next chapter and, they hope, pull off a turnaround. A huge part of their future plan is right here in this quote from the report. They're actively working to get back into the market in Thailand, which they call a high-potential market. This is a big signal that they're making a strategic pivot toward new places that they think will offer better growth and, just as importantly, better profits. And this slide pretty much lays out their entire roadmap. First, they're not giving up on their home turf. They're launching a new product in Singapore. Second, they're going to keep pushing in Malaysia, which is where that revenue growth came from. Third, as we just saw, they're going after Thailand. And finally, they're going to do all of this by staying focused on small and medium businesses, which are their core customers. So why Thailand? This slide gives you the answer in a nutshell. The mobile payments market there is projected to be absolutely massive, growing to nearly $60 billion by 2030. OxPay is looking at that number and seeing a gigantic opportunity. If they can just grab a tiny piece of that pie, it could completely change their financial future. It's a high-stakes bet on a really high-growth market. And that brings us all the way back to our big question, but now with a whole new perspective. We started with this puzzle, right? Growing sales and growing losses. We've seen exactly why that's happening. It's a mix of lower margin business and rising costs. And we've seen the company's plan for a turnaround, focusing on new products and new markets. So the crucial question we're left with is this. Can this new strategy actually steer the ship in the right direction? Can OxPay finally make its growth profitable? Well, the next few quarters are going to tell the story.